Welcome to Truth Behind History. Today, we're diving into some of the most catastrophic stock market crashes in history, moments when fortunes vanished overnight, economies crumbled, and the financial world was thrown into chaos. Stock market crashes aren't just numbers on a chart, they shape economies, spark political shifts, and leave lasting scars on society. But why do they happen? What can we learn from them? And how do they continue to influence global finance today? In this video, we'll break down the biggest crashes, from the infamous 1929 Wall Street crash to the chaos of 2008 and even the COVID-19 market plunge. We'll explore what triggered these financial collapses, the devastating consequences that followed, and the lessons they offer for investors and policymakers today. So, let's get started. Throughout history, stock market crashes have played a critical role in shaping economies, governments, and financial institutions. But before we get into the details of specific crashes, let's first understand why they matter. Historical significance. Stock market crashes are not just financial events, they are historical events. When a market collapses, it's not just a few investors losing money, entire economies can be thrown into recession, unemployment skyrockets, governments scramble to respond, and sometimes, global conflicts even arise from economic turmoil. Crashes influence economic policy, change regulations, and can even determine the fate of political leaders. Key factors behind crashes. So, what actually causes a stock market crash? It's usually a mix of speculation, financial instability, and external shocks. Speculation happens when investors get overly confident, throwing money into stocks without considering their true value. Financial instability can come from high levels of debt, weak banking systems, or even technological changes. And then, there are the external shocks, wars, pandemics, natural disasters, things that nobody saw coming but can send markets into free fall. Lessons from the past. If history has taught us anything, it's that understanding past financial disasters can help us prevent, or at least soften, the blow of future ones. By analyzing the patterns of previous crashes, investors and policymakers can make smarter decisions, build better safeguards, and hopefully avoid the same mistakes that led to financial ruin in the past. Now that we have the foundation, let's look at some of the most infamous stock market crashes that changed history, starting with the granddaddy of them all, the 1929 Wall Street crash. The Wall Street crash of 1929 wasn't just another financial hiccup, it was the event that set off the Great Depression, the most devastating economic crisis in modern history. And it all started with one thing: overconfidence. Market collapse. Before the crash, the 1920s were a time of economic boom, often called the Roaring Twenties. People believed the stock market could only go up, and speculation was rampant. Banks handed out loans like candy, and ordinary citizens were investing their life savings, convinced they'd become rich overnight. But then, in October 1929, reality hit. Stock prices started tumbling, and when panic set in, investors rushed to sell, causing the market to collapse. By the time the dust settled, stock prices had fallen by nearly 89% from their peak, wiping out billions in wealth. Economic consequences. The crash wasn't just a Wall Street problem, it rippled across the economy, leading to business closures, skyrocketing unemployment, and a banking crisis. Within a few years, 1 out of every 4 Americans was unemployed. Families lost their homes, food lines stretched around city blocks, and the Great Depression took hold, lasting for nearly a decade. Lessons learned. One of the biggest takeaways from the 1929 crash was the danger of excessive speculation and lack of regulation. There were no safeguards in place, no government insurance for bank deposits, no rules to stop wild stock speculation. This crash led to major financial reforms, including the creation of the Securities and Exchange Commission, SEC, to regulate the stock market. Now, let's fast forward to another infamous crash, one that happened in just one day but sent shockwaves around the world: Black Monday, 1987. If the 1929 crash was a slow-motion disaster, Black Monday was a lightning strike. On October 19, 1987, stock markets around the world plummeted in a single day. The Dow Jones Industrial Average dropped 22.6%, erasing over $500 billion in market value. That's still the largest one-day percentage drop in US history. But why did it happen? Largest one-day drop. Unlike previous crashes caused by weak economies or banking failures, Black Monday was unique. It happened at a time when the economy was actually doing well. But excessive optimism had once again inflated stock prices beyond reason. When investors suddenly realized prices were unsustainable, a selling frenzy began. Computerized trading. One of the biggest culprits in Black Monday's rapid decline was computerized trading. At the time, financial firms were experimenting with automated sell orders. These algorithms were programmed to automatically sell stocks when prices dropped to a certain level, except, when everyone's computers started selling at once, it created a snowball effect that turned a minor dip into a full-scale market collapse. Psychological impact. Fear played a massive role in this crash. Investors panicked and herd mentality took over. As more and more people rushed to sell, the market spiraled downward. It was a brutal lesson in how investor psychology can sometimes be just as dangerous as economic fundamentals. Luckily, this crash didn't trigger a depression like in 1929, but it did lead to regulatory changes, especially new rules to slow down automated trading in the event of a sudden crash. Now, let's talk about a crash fueled by a different kind of frenzy, one that revolved around the internet and dot-com stocks. The late 1990s were an exciting time. The internet was changing everything, and investors were convinced that anything related to tech would make them rich. Startups were popping up everywhere, and investors poured billions into these companies, even if they weren't making any profit. Tech stock surge. Between 1995 and 2000, the Nasdaq, a stock index heavily weighted toward technology companies, shot up by a staggering 400%. Everyone wanted in on the internet revolution. Companies with no revenue and no clear business model were getting millions in investments just because they had .com in their name. Market collapse. But, of course, hype can only take you so far. By 2000, it became clear that many of these companies were built on nothing but dreams and speculation. When reality set in, the bubble burst. The Nasdaq lost 78% of its value, and once promising startups crashed and burned. Companies like Pets.com, which had spent millions on advertising but made almost no profit, became infamous for their rapid rise and equally rapid demise. Long-term impact. Despite the devastation, the dot-com bubble had a silver lining. While many companies collapsed, some survived and thrived. Amazon, for example, struggled during the crash but emerged stronger. Google, which was just getting started, avoided the bubble altogether and became a tech giant. This crash reinforced the idea that investing in hype rather than real value is a dangerous game. But if you think the dot-com bubble was bad, wait until we get to 2008, when the entire global economy was brought to its knees by one thing: subprime mortgages. The 2008 financial crisis wasn't just a stock market crash, it was a complete meltdown of the global financial system. It wiped out trillions of dollars, led to mass unemployment, and nearly brought down some of the world's biggest banks. And at the center of it all? One thing: subprime mortgages. Before the crash, banks were handing out home loans to anyone and everyone. It didn't matter if you had bad credit, no income, or no way to repay, the bank still gave you a loan. These risky mortgages, known as subprime loans, were bundled together and sold to investors as safe financial products. At first, it seemed like a win-win. Home prices kept going up, so if a borrower couldn't pay, the bank could just sell the house for a profit. But there was one massive problem: this entire system was built on the assumption that home prices would never go down. Spoiler alert, they did. When homeowners started defaulting on their loans, the entire house of cards collapsed. Suddenly, these mortgage-backed securities were worthless. Banks holding them lost billions, and the crisis spread like wildfire through the global economy. One of the most shocking moments of the 2008 crisis was the collapse of Lehman Brothers, one of the largest investment banks in the US. When Lehman declared bankruptcy, panic spread. If a giant like Lehman could fail, who was next? Banks stopped lending money to each other, businesses couldn't get loans, and the entire financial system started freezing up. Stock markets plummeted, the Dow Jones lost over 50% of its value from its 2007 peak. Retirement savings were wiped out, companies collapsed, and unemployment skyrocketed. Unlike in 1929, the government didn't just sit back and watch. In an unprecedented move, the US government launched massive bailout programs to prevent total economic collapse. The Troubled Asset Relief Program, or TOP, pumped hundreds of billions into banks to keep them afloat. The Federal Reserve slashed interest rates to near zero, and later, governments around the world followed with their own stimulus packages. Did the bailouts work? Well, they stabilized the economy, but they also sparked massive debates. Some argued that rescuing banks rewarded the very institutions that caused the crisis. Others pointed out that without intervention, the world might have spiraled into another Great Depression. The 2008 crisis was a brutal lesson in what happens when reckless lending, overconfidence, and a lack of regulation collide. But just a decade later, another market crash would shake the world, this time caused by a global pandemic. The COVID-19 market crash was unlike any before it. It wasn't caused by speculation, bad loans, or a housing bubble, it was triggered by fear and uncertainty on a global scale. When the world realized that COVID-19 was more than just a regional outbreak, stock markets tanked. The S&P 500 plunged 34% in just 1 month, marking one of the fastest market declines in history. Businesses shut down, travel stopped, and for the first time in modern history, entire economies were put on pause. Unlike previous crashes, this wasn't just about financial markets, this was about human survival. The fear wasn't just, will my stocks go down? It was, will the global economy even function if everyone stays home? Governments reacted fast. The Federal Reserve and central banks around the world injected trillions of dollars into the economy, slashing interest rates and pumping money into businesses to prevent mass bankruptcies. The US government issued stimulus checks directly to citizens, hoping to keep the economy from collapsing. This level of stimulus was unprecedented, far beyond anything done in 2008. Governments essentially printed money at record levels to keep businesses and individuals afloat. Despite the historic crash, the market bounced back just as quickly. By late 2020, stock markets had not only recovered but were hitting all-time highs. Why? Tech and healthcare stocks soared. Companies like Amazon, Zoom, and Pfizer became essential in the new world of remote work and pandemic response. Low interest rates fueled investment. With borrowing costs near zero, investors flooded back into the market. Government support prevented a deeper collapse. Unlike 1929 or 2008, massive stimulus prevented widespread financial ruin, allowing markets to rebound far quicker than expected. But while the stock market recovered, the real economy took much longer. Many small businesses never reopened, supply chain issues persisted, and inflation would become a major problem in the years that followed. So, after looking at all these crashes, what lessons can we learn? Let's break it down. Every stock market crash teaches us something about how economies function, how investors behave, and how governments respond. Almost every major crash starts with overconfidence. Whether it's the 1929 stock market frenzy, the dot-com bubble, or the 2008 housing market, speculation drives prices to irrational levels. When investors stop caring about fundamentals and chase quick profits, markets become fragile, and eventually, they collapse. The government's response to a financial crisis can determine how bad things get. In 1929, there was no intervention, and the result was a decade-long Great Depression. In 2008, bailouts helped prevent total collapse, but sparked controversy. In 2020, massive stimulus propped up the economy but contributed to long-term inflation. The takeaway? While government action can help stabilize economies, it also has long-term consequences. For investors, diversification and long-term strategy are the best defenses against crashes. Those who panic and sell at the bottom often lose the most. Meanwhile, those who stay calm and invest wisely often come out stronger. Markets are unpredictable, but smart investing can help weather financial storms. So, what have we learned from history's biggest stock market crashes? Market cycles are inevitable. Every boom eventually leads to a bust, it's just how markets work. Preparedness is key. Investors who manage risk and think long-term fare better than those chasing quick profits. History repeats itself. The same mistakes, overconfidence, speculation, poor regulation, keep causing financial disasters. The more we learn from the past, the better we can prepare for the future. If you enjoyed this deep dive into financial history, make sure to like, comment, and subscribe to Truth Behind History. Let us know in the comments, which stock market crash do you think had the biggest impact on history? And if you love learning about history, check out our other videos for more fascinating stories. Thanks for watching, and we'll see you in the next one.